Welcome to The Explainer. Today, we're going to dive into a moment when a massive geopolitical crisis hit the news. You'd think markets would absolutely panic, right? Well, they did something nobody saw coming.
So let's set the scene. The date is January 4th, 2026. Over that weekend, one single piece of breaking news drops, and it's about to set off this totally bizarre, super fascinating week for global finance.
And here's the headline that dropped like a bombshell. U.S. authorities confirmed they had captured Venezuelan President Nicolás Maduro and his wife, Celia Flores. And get this, they were immediately flown to New York to face some really serious charges of narco-terrorism conspiracy. I mean, wow. Now, to really get why this is such a huge deal, you've got to remember what Venezuela is in the grand scheme of things. We're talking about an absolute energy giant. They were a founding member of OPEC, and they hold the largest proven crude oil reserves on the entire planet. That's a staggering 17% of the world's whole supply. Just let that sink in. All right, so you've got this major oil superpower just thrown into total chaos. The market reaction should be pretty obvious, right? But what actually happened? Well, that's the big mystery we're going to unpack today. Okay, let's just use a little common sense here. If the leader of a country that sits on 17% of the world's oil is suddenly, taken out of the picture, what's the very first thing you'd expect to happen to the price of oil? Everybody expected a massive price spike. People were bracing for it, fearing supply disruptions, instability, the whole nine yards. But the reality? It was the complete opposite. Prices actually went down. And we're not talking about some tiny little blip on the radar either. Brent crude, which is the big global benchmark for oil, it dropped 0.25%. And the U.S. benchmark, West Texas Intermediate, it fell even more. This just completely flew in the face of all conventional wisdom. Okay, so things are already weird, right? But this strange reaction wasn't just happening in the oil markets. As the first trading week of 2026 kicked off, this shockwave hit the Asian markets, and they didn't react with fear. Nope, they went on a massive buying spree. So over in Japan, the Nikkei 225 just had this absolutely spectacular start to the year. It just rocketed up by a massive 2.82% in its very first session. Incredible. And it was pretty much the same story in South Korea. The Kospi index didn't just climb. It surged 2.41%, completely smashing its old record to hit a brand new high. The bulls were definitely out. But okay, inside this big, broad rally, there was something even more specific, even more dramatic happening in one tiny little corner of the market. You see, the market made a direct link between this news and, well, security. Defense stocks in the region just exploded. Investors were basically betting that all this regional instability could lead to a big uptick in military spending. You had Mitsubishi Heavy Industries surging 6.4%, Kawasaki Heavy jumped 5.7%, and over in South Korea, Hanwha Aerospace was up a solid 4%. Okay, so let's just recap, because this picture is just bizarre. A major geopolitical crisis hits. Oil prices fall, and defense stocks surge. It feels like a total contradiction, right? So let's get into it and decode the market's hidden logic. So this really is the million-dollar question, isn't it? How can an event that screams global instability cause the price of something as critical as oil to drop, while at the very same time boosting stocks that are tied to conflict? Okay, here's the key thing you have to understand. The market is always looking ahead. It's a forward-looking machine. For those oil traders, Maduro's capture wasn't seen as the start of a conflict. They saw as the potential end of years and years of uncertainty in Venezuela. So their calculation was, hey, this could actually lead to a more stable, more reliable flow of oil down the road. That reduces long-term risk. And in the short term, they clearly weren't too worried about any immediate supply disruption. And that right there just perfectly captures the core idea. It's like investors weren't trading on the chaotic breaking news headline of a captured president. They were placing their bets on the possibility of a more stable future for a nation that happens to be sitting on a sea of oil. All right, let's zoom out one last time and put all these seemingly contradictory puzzle pieces together to see the full picture. And here it is, all laid out for you. You've got oil prices falling, which signals hope for that long-term stability we talked about. You have Asian stocks surging, basically cheering the removal of a big global risk factor. And what about gold? The classic safe haven asset? Well, it ticked up just 1%. That's like a small hedge, showing that, yeah, traders were optimistic, but they weren't, throwing all caution to the wind. It's just a perfect summary of a really complex, nuanced market reaction.
So what's the big takeaway from all this? It's a really fundamental lesson about how finance works. Markets are basically a giant betting machine on the future. They don't just react to what's happening right this second. They're constantly reacting to what they think is going to happen months or even years down the line. And that kind of leaves us with this really fascinating question to think about, right? In today's super interconnected global economy, is it possible that a shocking piece of what looks like bad news can actually be good news for the future? It's just a great reminder that in the world of finance, nothing is ever quite as simple as it seems. Thanks for watching.